mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates, here we are for episode 16, the podcast where we break down the world of investing to try and make it easier for you guys to understand. And as always, I'm excited to be here with my equity buddy, Ren. How are you, mate?
I'm good, Bryce. How are you?
Yeah, can't complain.
Yeah.
Midweek, hump day, it's almost the weekend. So let's get stuck into it. This episode, we're going to be talking about a couple of things that we've learned this week. And then we're going to crack into discussion on the earnings season, which is perhaps one of the more nervous times of year for investors and fund managers, and because it's that time of year where companies are releasing their end of year results to let us all know how they've been going.
I guess the first question straight off the bat, end of year, isn't it only August?
Yeah, say what? How does that work?
Yeah.
Well, I guess we'll get into that when we talk about the earnings season.
Oh, now that's a nice tease. That's why you're paid the big bucks.
Yeah, so there's a few things what we want to discuss. We want to talk about a few notable results that have come out, what earnings season can mean for you and I. Does it even matter? And, you know, what's coming up, because as I said, we're only halfway through. So that's what we're going to cover. It's a very exciting time of year for investors and those interested in the market. Let's get stuck into it. What we've learned this week.
I reckon you should kick us off this week.
Okay, well,
Yeah.
Probably the thing that I remember most, it's not really to do with stocks at all, but I watched a great Netflix documentary called Icarus. And it outlines the doping saga that went on in the Russian Olympic community amongst their athletes during the 2016 Rio Olympic Games. Now, I'm not sure if you remember, but they were banned from competing. All Russian teams were banned from competing only a matter of, I think it was about 7 or 9 days before the Olympics started. And I'm sure due to huge political pressure, they were allowed to compete in the end. But this documentary essentially outlines this huge scandal that was essentially given permission by Putin. He was the one who started this whole thing, that every single team, and not necessarily every single athlete, but every single team had athletes that were doping, and, you know, these informants who were sneaking into WADA buildings, drilling holes through walls and slipping out urine samples. And it was this whole organized sort of doping saga that went on. So I'll keep it at that, but very interesting.
I'm sure there's a way we could somehow link that to investing, but you know,
don't trust the Russians. I don't know.
Yeah, don't invest in Russia is probably a very good one, especially at the moment.
I promise next week I'll have something a bit more investing related, but look, I just found it incredibly interesting, and if you have the time, definitely give it a watch, because it just blew my mind that this came from the absolute top, and, you know, they were killing people who were blowing the lid on this, and this documentary accidentally stumbled upon the head of the program, this guy who was making all of the doping drugs and tests to cheat the system, and he's now in protective custody in the United States because the Russians want him dead. So,
really? Wow.
Yeah, he blew the lid on this documentary.
God, There you go. Equity Mates, your place for investing advice and Netflix advice. What more could you want?
Yeah, keeping it real.
Yeah. All right.
Well, what did you learn then?
My learning is a little bit more finance related. So financial literacy is, I guess, the theme. You know, that's why we do this podcast. We think it's really important that people understand their finances, understand what's going on in the market. Anyway, I came across this study by a Wharton Business School professor, and she put together 3 questions that is meant to be a test of financial literacy. And would you believe it? Only a third of Americans could get it right, and only 44% of college-educated Americans could get it right.
Oh,
so
okay.
a little bit worrying.
You're going to do this live on air to me right now.
Yeah. So pulling back the curtain, haven't told Bryce anything about this yet. I figured we'd see how financially literate Bryce is, and also all our listeners can play along at home.
Do I need a pen and paper?
No, you don't need anything. Now remember, only a third of Americans got this right, and only 44% of college-educated Americans got this right. So,
okay, well, keep in mind I've been crunching numbers all day.
Yeah, no shame if you get this wrong. You'd be in the majority if you didn't pass. But all right, so financial literacy. Question 1. Suppose you had $100 in a savings account and the interest rate was 2% per year. After 5 years, how much do you think you would have in the account if you left the money to grow? A, more than $102. B, exactly $102. Or C, less than $102.
A, more than $102.
Yeah, that is correct. correct because if it's 2% a year and you have $100 in there, the first year you'll have $102, and then from years 2 to 5, obviously it will go above $102.
Yes.
There you go, mate.
Okay.
1 for 1. You see, what are you worried about?
So I now am on par with most of them.
No. There's 2 questions to go.
Okay, yeah.
Yeah. So number 2, imagine that the interest rate on your savings account was 1% per year and inflation was 2% per year. After 1 year, how much would you be able to buy with the money in this account? A, more than today. B, exactly the same. C, less than today.
I'm going to have to lock in C, Eddie. Less than today.
Nice one, mate. 2 out of 2. And
Yes.
so for any listeners unsure, the reason that that's the case is if inflation is rising at 2% a year, but your money is only growing at 1% a year, then the amount that you can buy with your money is less.
Yeah, because inflation is the rise in prices of everyday goods.
Exactly.
Yeah.
All right, nice one. Hopefully everyone playing along at home is also on 2 out of 2.
Ding, ding, ding.
Now,
What's the prize?
Number 3, are you in those vaunted few who are financially literate? Number 3, please tell me whether this statement is true or false. Buying a single company's stock usually provides a safer return than a stock mutual fund. For those unsure of the terminology, a stock mutual fund is a fund that holds a variety of different stocks.
Okay, from a basic perspective, I am going to say the answer to that question is false.
So the mutual fund is safer.
Correct.
Yeah, nice one. Nice one. There you go. 3 out of 3, mate. So you're in that third of Americans that could answer all 3 questions, and so according to this test are financially literate.
Thank goodness for that.
So the reason I wanted to bring that to the table today is, it might be surprising to some listeners that, they got a couple right, they got all 3 right, just how advanced they are compared to, we are talking about Americans, but I'm sure if you did it in Australia, you might get similar results as well.
I'm sure.
Financial literacy it's not exactly high up on people's priorities, but, to my mind, it is the most important thing to secure your future and to live comfortably and retire well. So, get nail down the basic, understand interest and inflation, and go from there. Hopefully everyone listening got 3 out of 3, or at least learned something, so they'll get 3 out of 3 next time.
No, that was good, Ren. I enjoyed that.
Yeah, I'm glad you got all 3 right. That could have gone
could have been the end of the
very
podcast.
sour. Yeah.
Lost for all credibility.
Yeah.
Mate, I'm going to definitely have to step up my game for next week's. What have I learnt after that one? So
No. I like the Netflix recommendation. I haven't seen it yet, so I'll have to get on it.
Get on it.
Yeah.
All right. So reporting season, or earnings season, or the silly season, or
Earnings palooza.
Earnings palooza. The time is upon us where all publicly listed companies are now obliged to report their earnings and result for the last 12 months. And as I said at the start of the show, Ren, that this is a time that can make some investors very nervous about the investments that they've made, because if you're holding a stock and it comes out with a performance that you were not expecting, it can either have adverse or positive effects on the share price. So, Ren, do you want to give a bit of an explanation briefly as to what is earnings season?
Yeah, definitely. So to start at the very beginning, the financial year runs from the 1st of July to the 31st of June every year. And all earnings season is companies, the financial year ends on the 31st of June. They figure out how much money they made for the year, in some cases how much money they lost for the year. They look at all their important metrics, how many items they sold, how many customers they acquired, all that stuff. And then they have to report that to the market. So
do they have to?
Yeah, if you're a publicly traded company, if you're on the stock market, then you have to. That's part of the conditions for being a publicly traded company.
Yeah.
And look, there's heaps of reasons for that. You're publicly traded. You have an obligation to let all investors know all the information. Otherwise, you're going to have a situation where savvy investors or people with connections will have a heap more information than anyone else.
Yeah, well, the investors are essentially the owners of the company, so they have as much right as anyone to know how the company is
definitely.
going.
Yeah. So how it works is because the financial year ends 31st of June, then the bulk of companies report in August. Some do it in late July. But what we have is basically a month of every day, except for Saturdays and Sundays, we'll get different companies listed on the stock market telling us how they've gone. The market will react to that. And, it's an important time of the year to see how your investment is going, whether what you think about the company is playing out or whether you were completely wrong.
My second question is there a cutoff for reporting season? Do you know, or can the companies just report whenever they want between now and the end of the year?
That's a good question. There will be a cutoff. Unfortunately, I don't actually know when the cutoff would be. Do you know?
Yeah, it's the end of August.
Okay, so they've got to be done by the end of August.
Yeah.
The next question we should probably address is how much should we care about it? Should we be poring over every page of annual reports, or
is it a big deal?
Yeah, exactly.
Yes and no. Obviously, if you're working in an investment fund or you're full-time dedicated to investing, then you're going to pay a lot of attention to these reports and go through the annual reports and the investor presentations and scrutinize the numbers and formulate your own opinions about what's going on. But for investors like you and me, Ren, I would think that it's important to understand where your company's at. And one of the things I really like about reporting season is that usually the companies will give you a sort of estimation of what's coming, what are their growth strategies, what they sort of see their earnings as going into the next year. And I like to use that as a judgment of whether or not I'm going to buy more of the stock or hold the position I'm in. So I do put some sort of weight on this period of time. Do you think it's important?
Yeah, I really do. And I think it is for a number of reasons. So the first one that we touched on before is you can see, when you buy a company or when you buy a stock, you should have an idea of why you're buying it. You think it's going to sell 1 trillion units in China, or you think, I don't know, it's got some crazy new drug that it's going to put on the market that will cure cancer. You have a reason, and this is a really good chance to take stock and see if they're progressing towards that goal.
No pun intended. Take stock. Keep going. Sorry.
Legitimately no pun intended. Yeah, so you can see how they're going, and every company will release an annual report, and that's a good opportunity to read how senior people in the company perceive how they're going. So, they'll talk about the opportunities, the threat, how they've gone, how they're going. So really good opportunity to get some perspective that you rarely get throughout the year, at least in that much detail.
So speaking of throughout the year, just before you go on, sorry, Ren,
it
got me thinking. So, if I have to wait, it seems a bit ridiculous that they release now and then I have to wait a whole another year to get another annual report or get another earnings. Is there anything that happens?
It does seem a bit ridiculous, doesn't it?
Is there anything? It does.
I wonder if anyone else has ever thought that.
Mid-year or throughout the year that I get an idea of how companies tracking? Yeah,
so what you're alluding to is companies also have to report on their half-year results. So from 1st of July through to, is it the 31st of December or?
Something like that.
Yeah, there'll be a statutory cutoff period.
Literally half the year.
But essentially it's they release their half-year results in February generally, and it's about the first half of the financial year and how they've gone. And so that's another opportunity. There's not as much detail as the full year report, but it's another good opportunity for investors and the company to take stock and to look at how they're going. But what I was going to say about the end of year result, it's important to care, but it's also a time when some people care too much. Now, what do I mean by that?
Yeah, what do you mean?
So as we keep saying on this podcast, the biggest advantage you can have in the market is taking a really long-term perspective and not trying to make, a quick buck, not trying to day trade, because there are far more sophisticated investors out there doing that who have far more time, far more knowledge, far more people working for them, and that we don't have an advantage.
No.
But what you see around earnings time is that these people, these day traders, they try and make a lot of money based on the earnings. So they'll try and predict how a stock is going to go, and if a stock profit beat expectations, then you'll see it shoot up. But similarly, even if a stock is doing quite well, and even if it's increased its profit, if it hasn't increased its profit as much as the market might want it to have or might have expected it to, you will see it decline, and you might see it decline more than is sort of logical, I guess. So there is sometimes opportunities to get stock a little bit cheaper just because of the amount of short-term trading going on around time.
So it sounds like what you're saying is that the reporting season can actually be quite a volatile time. And so because people are coming out to not necessarily invest, but they're coming out to play with the sharp movements in price.
There's a lot of chat about, expected result this and speculation that before they report. I mean, it's heaps worse in America. If you turn on an American stock market channel or business channel before one of the big companies, like Google or Boeing Morning or any of them report, oh God, they just don't shut up about what they expect. It's
Yeah,
just like,
yeah.
cool your jets. They're going to report soon enough, and then we'll actually know.
It is ridiculous.
Yeah,
It is ridiculous. And it's something to keep in mind because it's so easy to get caught up in this period. If you see a stock shooting up, you've got to hold yourself back and just, remember that this is almost entirely based on market expectations and investor sentiment. And it's, the company's fundamentals haven't changed. They've just literally put out a piece of paper that says their profit or loss. So
it's a classic example of separating the signal from the noise.
Yeah.
So there's a lot of noise around this time because people have their expectations built into the price, and you see price swings more than normal. But the noise is there. The noise is how companies are actually doing, how they're actually going in the market, how their new products are actually going, how much profit they're actually making. But around that, there's so much noise that just you need to block out because, in 2 years from now, it's not all that noise isn't going to matter. What's going to actually matter is the signal, how the company's actually going as a company. So I guess that's all very general. Maybe let's get into some specific about this reporting season and what we've seen.
Yep. I'll kick off one with an example of what we were just talking about, how good results don't always equal a positive price movement, and then perhaps we'll go into some positive results. And something that sticks out, and probably one of the biggest stories, is a company called Transurban.
They're an infrastructure company. Now a lot of people might not have heard of them, but everyone who lives on the east coast of Australia has dealt with them. They own basically all the major toll roads in Brisbane, Melbourne, Sydney, all up and down the eastern seaboard. So, you've paid your tolls to them even if you haven't heard of them. Yeah,
well, we've definitely paid their tolls because the group generated revenues of $2.7 billion during the 2016-2017 financial year, which was 22.7% higher than FY16. Profits rose to $209 million. Now, that's operating profit. Compared to last year, that's an increase of 850%. Last year, they made a $22 million profit. This year, $209 million. Now, Ren, to me, that sounds like a company that has absolutely smashed it out of the park.
Yeah, roads are a good business to be in.
Roads are a good business to be in. However, as a result, you would expect the stock price to go up. However, investors weren't too happy for some reason that with the results, and the price fell, which you would think is surprising. But it's an example of if the expectations of the investors don't meet the results that are put out by the company, then they're going to reward you with selling your stock. I think one reasons they weren't so keen on them was because they were doing a capital raising to try and get some money to fund more infrastructure development.
Yeah, so this was just some noise in the report, in their annual report, and in some of their statements to the market that they're probably going to need to raise a bunch of capital to build the next lot of toll roads that they're currently bidding on, including the West Connects in Melbourne, which is going to be a huge one, which will generate heaps of revenue for them. They're going to have to come hat in hand to shareholders to ask for some money to do it.
Yeah, well, the shares fell 31 cents on the day that the results were released, so certainly not the result that I'm sure shareholders,
you got to be pretty stoked that they made $209 million. It's like, calm down, guys.
I know, 150% increase.
Yeah,
unbelievable.
Yeah, just people are never satisfied.
No, and another example, Seek.com, the website that deals with finding the right people for the right job. It's a jobs classified website. They reported that they, for the first time, cracked the $1 billion revenue.
Yeah, which is crazy to think about.
I know, it's a ridiculous figure for
a website.
I know, online company.
Yeah.
And that's with figures of 9.1% growth, from 960 million to 1.05 billion, net profit of 362 million. And so, things are looking good for Seek. They've got a great market position. And
yeah, I mean, well, you wouldn't go anywhere else to look for a job in Australia, really. It would at least be the first place that you went to.
Classic example, though, the figure actually exceeded the guidance that was given by the company, but it didn't impress the investors enough, and the company today went down 5%, which is a pretty big drop, but they say that that's because investors weren't happy with what the company was saying they were going to be doing going forward into the future with their estimates. They were saying the costs were going to be rising faster than their revenue, but look, if you were to say that you're growing at 10%, you've cracked the $1 billion mark, you've made $360 million in net profit, and then say it's not going to be as rosy next year, but we're still going to be as good. And they got slammed 5%. So you can never read it.
So I guess it's probably important to explain that a lot of these companies, all share prices are priced for future earnings as well. So that's why, you might pay like 15 times current earnings per share in the share price. And that's because, you buy these companies with the expectation that they'll keep growing that they'll keep growing essentially. That's why, even if they're making $360 million a year, if that's going to stop growing, then it's all about the price that you pay for the profit. And I don't actually know what they're trading in terms of how many times
I think it's quite high, to be honest.
Yeah.
But that's all relative.
But look, to be honest, so many of these internet companies like realestate.com, carsales.com, seek.com, everyone's always said they're bloody expensive and they always keep crushing it. Like
I know.
They're just these, they're not internet monopolies because they all have competitors. Car sales not as much, but they've all got competitors. It's just that their competitors can't really do much against them. They're so dominant.
Keep churning through.
Yeah.
Look, I don't know. It's just one of those things. I'm sure that the forward-looking estimates aren't going to be saying, "Oh, we're going to be dropping from 10% growth to 2% growth." They probably said we've been growing at 9.1% this year. Next year we're going to foresee 8.95 or something.
Which is still great. Like, once you're a market leader and you dominate the market, it's tough to you have to expect the whole market to grow rather than for your market share to grow. And hopefully for Seek, heaps of people get fired and companies need to hire a whole bunch of new people and there's people looking for work because that's what they need.
Cool. So that's two examples that I had of the classic do well, get slammed. Do you have anything?
So I guess the opposite of do well. What was your term? Do well, go shit.
Do well, get slammed.
Do well, get slammed is do shit, get
rid.
Look, to be honest, I'm just going to stop trying. But look, so the opposite also applies. One company that saw its share price go up was Virgin Australia, and that was despite it reporting $185 million loss this year.
Okay.
Yeah, like riddle me that one.
My initial thought would be Virgin have almost consistently reported a loss.
Yeah, you're on the right track. Yeah.
So my thinking is that the reason their share price has gone up as a result of reporting a $180 million loss is because that loss is actually less than what it has been or less than what the expectations were.
Yeah, well, look, you're right on both counts. So their loss last year was $224 million. Okay, so they've improved by $39 million, say. That's better than what the market expected. So their share price went up, even though they lost $185 million. And it just once again shows that airlines are a hard business.
Yeah, tough.
There's one company that breaks records every time they report, and they consistently do it every year, and that's Commonwealth Bank. And they broke records again. This year they had $9.9 billion in profit. But look, to be honest, the ability to say Commonwealth Bank is record breaking is just, it is meaningless these days because they're every year they have the highest profit, and no Australian companies hit that profit level previously. And every year they creep up a little bit and it breaks the record again. And it breaks the record again.
Yeah.
So all this hype you hear about Commonwealth Bank, they broke the previous record, which they held last year. They're really just ticking along as
the share market reaction to them breaking profits year on year has substantially slowed down compared to what I remember it being when 5 or 6 years ago. I remember they released a full year profit of 7.2 billion or something, and that was just crazy. And the share market went nuts. It went up and up and up. But proportionately, the increases that we're seeing on Commonwealth, well, I don't even know if it did go up on the day. But as you said, like, what else can you expect now? Yeah.
I mean, look, they've also had all this trouble with the deposit machines in their ATMs and all the laundering issues there. Yeah. And then their CEO has now sort of been stepped aside, shall we say?
Respectfully told to resign.
But look, to be honest, he's going to get a nice little golden handshake.
Oh, big time. He'll be on board somewhere.
I mean, say what you want about the bloke, but you know, if his responsibility is to his shareholders, he has well and truly delivered for his shareholders.
Yeah.
And he's seen the bank through some pretty big scandals, some tough times, and mistakes. Like Commonwealth Insurance and stuff. Not the strongest of divisions, to say the least, but he just kept on delivering. So
he might need to jump on Seek.com.
Yeah. I think a lot of companies will be asking for his services.
Any other interesting ones that have reported so far?
Yeah, so Domino's reported today and got... Oh, not today, yesterday.
Another market darling.
Yeah. But look, Domino's is probably a classic example of investors were paying so much for future earnings that any sign that those future earnings won't pull through...
Yeah, one slip up, you're out.
Yeah. So look, Domino's fell, but if you've been a Domino's shareholder for the last 5 years, you are still well up on where you were.
Domino's fell 18.8%
Yeah.
in one day. So that's a huge loss. They came down almost $10. So, and then I think today they went up 7%. So made a bit of it back.
Yeah.
But
so that's probably a classic example of what we were saying before, where, because there's so much short-term trading going on, there's big overreactions to news, and then there will be a correction in the coming days. So, big overreaction, it falls 18%. The market realizes that it's too cheap, it reacted too harshly, and it will correct up 7%. Now, there's just one last thing that I want to talk about when it comes to earnings seasons and annual reports and stuff like that.
Yeah.
And that is a couple of buzzwords that you got to watch out for.
Okay.
Because companies love to talk about how well they're going. And if they can massage the numbers to make it seem like they're doing better, then they will do exactly
because
that.
they're scared of investors slamming them.
Yeah. I mean, investors are pretty scary as a group. They're pretty ravenous, and they will slam you if any bad news comes your way.
Or if any good news. So what are some key words to look out for?
So
Profit?
There's two that I want to talk about in particular, and it's all about the profit that you report, because that's the big number. And companies, profit, you think it's pretty easy. It's money you brought in minus your costs equals your profit. But you would be wrong, because companies have found ways to take that and then change it a little bit. So buzzwords to look out for: adjusted net profit or underlying profit. And essentially what that means is that they've taken a bunch of costs out of the cost part of that money in minus cost equals profit equation.
Yeah.
So for example, carsales.com, they reported that their adjusted net profit was up 8%. But what they actually mean by that is that their profit was actually only marginally up from the year before. But when they take a whole bunch of what they're calling one-off costs out of the equation, then it's up 8%. It's the same with underlying profit. Companies will say, oh, this cost over here or that cost over there, that was only a one-off. That doesn't affect our underlying profitability. That was just a one-off for this year.
Yeah.
And look, they're right sometimes.
Sometimes.
But at the end of the day, it was a cost that year, and it did affect your profitability. And as a shareholder, that does affect the amount of money that, can be reinvested in the company or distributed in dividends.
Yeah.
And, they're
trying to not fool, but trying to persuade the investors that
things are rosy.
They're still going all right.
And look, to be honest, there's nothing wrong with it. Like, it is an important metric to sort of take away the one-off costs and actually show how the underlying business is going. But as investors and as new investors, it's important to recognize the buzzwords and recognize what they mean.
See the distinction.
Yeah, and if you see that underlying net profit is up 8%, just have a quick look and see what the statutory profit is, which is because their statutory profit is because there are certain rules about the statutory number that has to be reported. Statutory means by law. So yeah, just have a gaze, have a bit of a look, understand some of those buzzwords, because at the end of the day, the company's not out to trick you, but it's out to paint the best picture of the year that's been.
It's their resume for the year.
Yeah, exactly. Bonuses are at stake, careers are at stake, share prices are at stake.
Nice one, Ren. Yeah. So that's a pretty nice wrap of some companies that have done well, haven't done well, been slammed, haven't been slammed. Just quickly to note, if you want to get some information on this, all of the companies that report, as Ren has said at the start, release an annual report, and they also release investor presentations that are most likely given by their CEOs or the boards at some point to some major investors, and they're all uploaded onto the ASX for all the public to see. So if you're interested in any companies, they will also be put on your brokerage platforms. So if you're interested to see how your companies are performing, or if you've got any companies that you are keeping an eye on and you'd like some more information, then head to the ASX asx.com and check out their annual report or their investor presentations. They usually do a nice sort of executive summary or a little bit of a slideshow with all the important keys and stats for you.
If you want to check out the reports that are coming and follow when they're coming out, you can just Google company reporting dates. There'll be lists on a bunch of different websites. But some of the big ones that might interest people, Blackmore's on the 23rd, same as Westfield and Flight Centre, both on the 23rd as well. Coca-Cola, Amatil, the Australian arm of Coca-Cola, on the 25th. You know, there's heaps of companies. You scroll down a list and it'll be household name after household name. So some really interesting companies to report. And, you know, it's a good way to see what companies are listed and what you can invest in.
Yeah, some big dogs still to come. So I just want to give a bit of a takeaway action we've spoken in a few episodes about, you know, where can I find ideas about investing, where can I find information and stuff. And this is a great period of time, as is the half-yearly reports, to sort of make a winners and losers list of stocks, especially the ASX 200, because they're the ones that you'll often see in the media the most. You might have to go searching for the lesser known ones because, as you said, Ren, all publicly listed companies do have to release results, but the bigger ones are also always definitely in the media, and there's a lot of winners and losers list made, and it gives you a good snapshot or idea of where companies are up to, and you can start to develop your own lists and just sort of create a watch list going forward that you can keep track of and see how the markets react to these companies when they release results. Have a look at their earnings and start, as you said as well, Ren, creating a thesis so that you can sanity check the thesis as you go along when they release reports. So this is a really good way to have their stocks are in the media a lot. They're in your face. You know if they're going well, if they're making money, if they'll tell you what they're going to be doing in the years to come. They'll give you an update on the industry. So all the information in a very short period of time becomes available without you really having to search for much. And as we just said, they're really trying to sell themselves as well. So they'll want to give you as much information as possible. So just a bit of
finding stocks and taking stock, you could say.
Yeah, exactly, Ren. Nice one.
Yeah.
So that's a wrap, I think, Ren. Is there anything else you want to mention or discuss around the reporting season?
Nah, look, I think we said it all. And if people want to know more, Google's their friend. There's heaps of information out there. So just, get stuck in.
Yeah, nice one. So as always, great to be with you. Like us on Facebook, rate us on our iTunes, give us a comment. It would really help. We've got some really exciting stuff coming up, some guests in the pipeline that we're keen to get to you. We haven't had an interview for a while. Thanks for sticking around, and we'll talk to you next week.
Sounds good. Equity out.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.